Okay, hey everybody. I'm Derek Smith, the founder of Plug-in South LA. I am here with some amazing investors doing some really cool stuff across the country. The title of this segment is Backing Opportunities That Brings Us Forward. We have a great, I'm excited to introduce the folks who are here with us today. We have Juliana Garaizar, investor at Portfolio Rising America Fund. David Hall, managing partner at Revolution's Rise of the Rest Seed Fund, Kai Bond, partner at Courtside Ventures, and Mac Conwell at Rare Breed Ventures. How's everybody doing?
Doing good
Good.
today,
Well,
man.
thanks for having me.
No, pleasure to have you guys here. I know that David he dropped out for a second. Hopefully he'll join us and get back into the conversation. We will go ahead and start. I think what I'd like to do is give each of you an opportunity to really sort of tell us a little bit tell the community at Urban Tech Connect about who you are for those who don't know who you are, about your fund and your companies, and what you're doing in this space. This is an interesting time to be an investor. I mean, as I mentioned earlier at the front end of the conference, the past year has been bananas, and with that. We've seen a lot of interesting activity in this venture capital space. I feel for like the first time in almost 5 years, there's this attention and focus now on the capital equation that plays into how we build and grow successful entrepreneurs across the tech ecosystems popping up across the country and the world. Each of you have sort of carved out a focus in an area in this space, and I'd love for you to take us through how you see the world presently at this moment in time from the perspective of a venture capitalist or an investor, right? And then from there, we can dive into a bunch of different conversations, but I'm here to facilitate and get information out of you to bring this community together around some of the topics that I think we all care about and how we're all trying to sort of move the needle forward around this capital issue in overlooked and marginalized communities from an investment perspective. So Juliana, why don't you kick us off? Ladies first.
Thank you. Thank you. So, this year has been pretty instrumental for us. Let me tell you a little bit about Portfolio. Portfolio is actually a platform. We run as a normal VC fund, but then in terms of how we function a little bit like an angel group. So our full role is not only to bridge the gender and minority gap. Most of our LPs are women and are diverse investors, but also democratize the access to that kind of investment asset class. One of the things we really believe is that we need to activate more women and more diverse investors into investing so that we can really bridge the funding gap in terms of entrepreneurs getting more funding from us. We don't want to wait for anybody else to create those funds. I think the answer is in us, and that's why we're trying to democratize access to these kind of investments. And our ticket size for our funds is fairly small, is 10K. And we also do a lot of education and empowering to our investors. So pitch sessions where our investors are able to not only visit with us in terms of the pitch, but also get involved as much as they want to in the due diligence process, in the deal sourcing. Many of our investors are actually sourcing deals for us, and also in everything except for the deal closing, where the 5 leads, in this case, 5 Black and brown women, 2 Latinas and 3 African American are leading the Rising America Fund. And I think it's become kind of a movement for us. We started with a few funds. Now the Rising America one is the 11th. We're going to pretty soon start raising Rising America 2 because we've been very successful. And we feel we are empowering a lot of people who didn't feel they had a seat at the table. We're also giving them oversized returns, so trying to bridge the wealth gap there too. But more than anything, we've become a movement to support many of the LPs who, at their turn, they started as LPs, and then we educated them, we empowered them, and suddenly they started running the next portfolio funds or their own funds or some angel networks all over the US. And we really believe that that has really motivated a lot of people to start, like, harnessing the power of their own purses. Even if you have like a little capital available, it's enough to make a huge difference. And that's what we're trying to achieve with the portfolio fund model.
Thank you for that. McKeever, why don't you sort of take it from there? Or
Yeah,
Mac?
so I mean, McKeever is my name, but most people call me Mac,
I know.
so
I don't want to
it
be so.
works.
I'm so formal here.
I know. Um, so at Rare Breed, we're in the process of raising our first fund. We're a pre-seed to seed venture fund, investing in companies primarily outside the major tech hubs, so outside of Silicon Valley, New York, and Massachusetts. We'll still invest in those areas opportunistically. Target check size 250,000, and we've made 15 investments so far to date. And when I think about this moment in time and investing, there's a couple things that are happening. One, the focus on investing in underrepresented founders, Black and Brown founders, is higher than it's ever been. At the same time, there's more capital in the market than we've ever seen before, and deals are moving faster than we've ever seen before. Like, deals are moving at incredible paces. And so you have this confluence of events that has the potential to lead to a lot of founders who traditionally wouldn't have gotten funding to not only getting funding now, but also being accelerated due to some of these market conditions. And like, those are the things that I'm excited for. Of the 15 companies we've invested in since January, 7 of them are raising follow-ons, and all of them are companies led by founders of color, right? That's not something we've seen often in the past. And so I'm really excited for, what we're seeing at the early stages, but, hopefully that'll keep up as the companies move from pre-seed and seed and go to Series A and Series B and beyond.
Thank you, Kai. Let's go to you. What's the current situation for you at Courtside Ventures?
Yeah, so first and foremost, thanks for having me as part of this panel. A pleasure to be with all of you. So Courtside Ventures is a early stage fund. We do pre-seed, seed, Series A, of $1 to $3 million checks, and we focus on 3 verticals. We started as a fund focused on sports, and from there expanded out into esports and gaming and fitness, health, and wellness. So we invest in those 3 verticals. My partner Vasu focuses exclusively on the sports side, deep in on the fitness, health, and wellness, and I focus on gaming. I think from a fund perspective, the macro level, we've actually seen, substantial tailwinds in the verticals we're in. Shelter in place obviously gave a massive boost to gaming and in-home entertainment. Anytime there's something that's shutting down gyms, that's a massive disruptive force. And I think as VCs, we run towards risk, and that means when there's disruption going on, you play in that space, and you see things like, the legalization of sports gambling and wagering across the country, and regulatory markets that are opening up, growing in billions of dollars. So we have unique market forces behind us at this moment in time. I think very similar to Juliana's points earlier, we look for LPs who are strategic and will add value. And where we as investors have spent, decades of time operating in our industries, understanding kind of publicly traded companies, what's going on in PE, where capital is flowing in markets. And I think, 2 observations I would make, about this, to McKeever's point with there's more money put in, right? I ran a $20 million fund at Catalyst that was focused on Black and Brown founders exclusively. And, we're just starting to where we're turning the corner from, Black and Brown funds funding businesses to tier 1 and larger funds accelerating their investment in those, right? So you look at, rounds that are happening at the $25 to $50 million range, which typically was not something that you would see with Black and Brown founders. You'd see million raised, 5 million raised, maybe 10. Right now, you're talking about, a dozen companies this year, one a month, I think, that we've seen that are raising, north of 100 million, right? You have these big, Play Versus is a good example of this, massive round from NEA, right? You see this with Squire. And so I think we're starting to see the breakthrough where there's so much capital that's flooded the market. You look at Cotu, you look at Tiger, you look at multiple tens of billions of dollars of rounds, and even the large institutional investors are having trouble keeping up competing on term sheets at that stage at the B, and they're pushing down. And the only way to have outsized returns in venture is bet against the grain. And so you see that from the LP side, betting on black and brown fund managers because they're seeing unique and differentiated deal flow. And that's all that's going to matter, because inevitably, if you're paying up for these, your returns are going to be squeezed. And so the way funding cycles work and what we're seeing, I was a founder. I started 3 companies. I started in 2006. There were no black and brown, funds I could go to at that point in time. And so we've seen funds being raised that are up to, I would say now, 145. It seems like a big fund, but it's tiny in terms of the capital allocation of large LPs. So we're just at this precipice and the turning point where we're going to see black and brown founder AUM going from total for all of our funds combined from 500 million to 5 billion in what will be likely a 7 to 10 year window. And corporates accelerated that this year, right? Will that funding be around for the next cycle? Uncertain. But I think what ends up happening is it's almost like proof of concept. You need to get your early stage fund 1 to get good returns so that you can start talking to institutional investors. So many of the folks here are probably raising money from high net worth individuals, family offices, corporates, some strategics. Now we're going to start moving to the next level, right? And so as capital flows into these funds and they get larger, more and more large checks will be able to be written. And McKeever's not going to be writing 250K checks. Matt's going to be writing $2.5 million checks, right? And so this cycle takes a long time. And it's hard when you're in it to be patient, right? Because we're all pushing as hard as we can. But I've been working in this field for 20 years now. And so I'm actually incredibly encouraged with where we are. And I feel like we're just about to see the hyper growth of this. And I think it's clear from the Kaufman studies and what you're seeing in the data and the research that's coming out is that 3X funds from emerging managers, many of which are black and brown, are the areas where LPs are seeing their greatest returns. And so I think the big question for all of us over the next 7 to 10 year window is, as we get more capital, can we sustain those types of returns and ensure that there's success, right? So I look at this as not only an opportunity and a great deal of fun in a career and a passion and profession, but almost an obligation, right? Where we can't see each other fail along the way. And so, we're at a very unique point in time. The band is growing, and the most important thing is for everybody to make sure that each and every one's funds are successful, both at fundraising, hitting their targets, as well as diligencing and making great investments. So that's kind of a few observations on my end.
That's great. A lot of nuggets there to unpack. David, what is happening in your world? How do you see the universe of venture capital in this emerging market of venture capital investors? What you talk about, sort of what you guys are doing at Rise of the Rest, and how you sort of see the present moment.
Yeah. First, what's going on in my world right now is the search for the most powerful Wi-Fi in my house, because that's why I was a few minutes late, because apparently my kids are all back on virtual school again. So my Wi-Fi just went.
You need Verizon 5G.
It's great to be here with you guys. It's so incredible to talk about this. Juliana, Kai, Mac, Derek, it's great to be able to have this virtual sort of roundtable about this issue. For those who don't know me, my name is David Hall. I'm the managing partner of Revolution's Rise of the Rest Fund. Rise of the Rest has always believed in seeing opportunity through largely the lens of geography, and we invest anywhere across the United States except for San Francisco, except for New York, except for Boston, thinking that there are really smart people in Detroit and Atlanta and Phoenix and Seattle and Nashville that have an equal shot at building the next generation of amazing startup. Without necessarily having to relocate to one of the coastal sort of hubs of venture capital and technology. And, one of the things for us that's always been happening, so, the last year has brought about a lot, right? We basically saw en masse what we've been talking about for a decade almost at the firm. And we saw a lot of people, psychically disconnect from a 1-bedroom studio in Midtown Manhattan or a 1-bedroom studio in the Mission, and say, I'm going to go spread my legs, spread my wings, go back home, try out a new place, and sort of the Rise of the Rest mission was like executed on because of the pandemic. And you saw people moving to all of these places and saying, wow, it ain't half bad being, or I'm able to take my 1-bedroom condo and buy a whole house in Cincinnati, Ohio. And then when big tech was able to sort of give them the air cover that said, you can live where you want for the year, we'll pay you sort of San Francisco level wage wherever you go, that really was that equalizing force that said, there are going to be a lot of people, most people will in fact likely move back, but those few that stay are going to be so transformative to a lot of these ecosystems around the country that we see, really infusing not a San Francisco way of thought, but a tech forward way of risk allocation that I think really does help infuse the type of psychograph that investors love to invest in, that entrepreneurs love to be around, that community, that groundswell of spirit that even I think markets like LA are benefiting from. Just the proximity to San Francisco enables that sort of acceleration of that movement. The second big thing that I want to give voice to, because May 25th, 2020, we all know what happened to Mr. Floyd, and now the world is starting to realize the vindication of that. But that tipping point moment in racial justice has really started to open a lot of eyes to inequities. And as Kai was talking about, this is my job and my passion and my also sort of part of my service is to take what I saw in criminal justice and try to reform my industry and try to do things to improve my industry. And it's funny, I remember several years ago there was a dinner it was like this big dinner. They were like, Black venture capitalists, we're going to have a dinner in New York City. And I was telling a couple of my partners here in our DC office that I'm going to this dinner. And they're like, oh, great. Is it a conference? Where are you guys holding it? It's going to be, is it going to be at Chelsea Pier? I'm like, it's at a table in a restaurant that we could reserve on Open Table, right? So, that means less than 8 people, right? And so to be able to now be a part of a growing community of venture capitalists that are learning the craft, that are coming in, growing up, coming over to the side, coming down from the top, coming into this world and into this realm, it's really great to see that passion, and we're here to support it. Final piece I will also say is what we did. One of the things that we consistently heard with Rise of the Rest, we're known for our bus tours, where we go do these tours in person in all these communities. And in the wake of George Floyd, we couldn't, and COVID, we couldn't do an in-person bus tour. So we flipped it on its side this year, last December, and we did an equity tour focused on Black founders specifically, because we know that their journeys are different when they're in some of these rooms, if they can even get access to the decision-making room or the partner, to the partner meeting. And we were able to source over 450 Black-led startups across the country, not in San Francisco, New York, or Boston, all kind of really answering the question about, where's the pipeline of these Black tech startups? And, we were able to find 3 that were the winners. We could have done, 3 times that and had equal, a dozen very equally situated companies. We picked what we thought were the best 3 in Reaply, Canaries, and Zerchu, and then invested in another 4 or 5 out of the finalist batch because we couldn't help ourselves because the quality was so great. But it really does shatter this notion that there isn't a great pipeline of Black tech talent building amazing companies across the country. So I'll pause there because it's a lot to talk about and unpack. But it's just I'm so happy and thrilled to be here and so excited as to what the future is going to lead for us.
Thank you for that. We have a lot of ground to cover, and I hope that we can get to some of the nitty gritty stuff to really, move the community and the conversation forward. But David, you mentioned something about sort of being in this space as an investor, being passionate about this, and having somewhat of some kind of purpose around this work that you do. I would love if each of you could just quickly, sort of explain how you got into venture capital. How did you end up here? And this is the more I look under the hood of venture capital, this is a really hard space to be in. This is not, people think you guys just write checks all day, and but there's a lot of process and a lot of grind and work to sort of manage this money. So anyway, how did you get into this space, and do you feel like this, like, what is purposeful about this work for you, each of you, at the present moment?
Yeah, I mean, I was really accidental in this space. I started working. I found a way to move to Revolution, which is a firm started by Steve Case, who was the co-founder of AOL, and with sort of his balance sheet, was able to start making investments, and then we built an institutional firm around his quote unquote family office. And so that was, I accidentally bumped into and grew up into this business and really had to grind hard to learn it, because I never worked at a classic venture capital firm, and had to sort of learn it as teach it to myself as I was practicing it. What drives me about this business is, I think, particularly for Black and Brown founders, is we have this lived experience that is so different and so valuable and so inherently entrepreneurial, that being able to sort of wrap it in a more traditional tech entrepreneurial wrapper with a product manager and a customer success team, like, creates these really strong product lines, product threads, be they financial services or D2C businesses, that I think need to really be exploited and examined, well beyond just hair care. But hair care is great and beauty is wonderful, but like, even looking at core fintech platforms, I think we should be looking at that. And it's like I said, it's my service to continue to talk to, elevate, and coach Black founders, whether or not we invest in them or not.
And so I'm happy to jump in and go second. And so for me, the way I got to venture is very it's very applicable to what happened last year. And so for me, I was a software engineer who was I was a two-time founder after that. My first company sold, my second company didn't work out, right? And so then I came back to Baltimore. I got a job in a marketing firm. And so I was at this marketing firm for a year, didn't really like my job, and then something instructive happened. In June of 2016, Philando Castile gets shot and killed by a police officer in his car. That same week, the marketing firm I worked for started soliciting the National Rifle Association for a contract with me as the lead. I quit that job on a Friday. The very next Monday, I got an email from the investment arm of the state of Maryland saying they were hiring. And I figured I knew startups, and I don't have a college degree, I don't have a finance background, but I know startups, I'm smart, I got some skills, and so I applied. And it was during a time where it just so happened that organization was also looking to diversify their workplace, because they didn't have anybody of color on their team with decision-making power. And so 4 months after that, they hired me, right? I recognized that the only reason I got that job was because of that moment in time. Fast forward to last year, George Floyd gets killed the day after my birthday. My birthday is May 24th. The very next month, I had one of my advisors tell me, go raise a fund. And so I started raising a fund. And you know what? I've been able to raise money from several institutions that I probably wouldn't have been able to raise from before. You know how I know that? Because every single institution that's backed me, that's not a family office or individual, but every institution has backed Rare Breed Ventures out of their diversity initiative that got started after what happened to George Floyd. And so my career path in venture is very tied to my experience as a Black man in America. And so for me, why am I passionate about it? I'm passionate for that reason, right? Like that is where my passion comes from, right? Like, I want the next generation of VCs who come through to not have to have initiatives or have to have racial awakenings, but to just be recognized for the skills and the knowledge that they have.
That's great.
I'll follow up. I think it's a little similar. I started my career in venture very serendipitously in Europe. I was running an angel network there. I happened to be in the French Riviera. Most of my angels were a little bit from all over the world, so we ended up running more angel networks wherever they came from, and started sidecar funds. And it was fun, and it was very global. So that gave me a very big perspective of how VC and early stage investing works in the world. And then I landed in Houston 10 years ago, and I really experienced bias there. I mean, I never felt this way before, and I was like, wow, I thought that I was coming to the land of the free and where Silicon Valley and VC started. So I thought, this is the place I need to be anyway. And boy, that was hard. It was hard. I was running the Houston Angel Network, experienced a lot of bias there, not only where I saw a lot of companies run by women and diverse founders being treated unfairly, but also I felt it in my own skin. So at some point, it was so obvious that I had to resign. I continued my stint in venture, and same thing, I started in a venture fund where they would totally ignore our decisions. I was the director and I had a investment committee, and the decisions would be bypassed on a whim. I was set aside, and someone else who was a golf buddy, took the role, and it was pretty crazy to see all these things. And I'm like, I've been trying to fit in so hard when I got into the US, and then I realized, you know what? I don't have to. I have a network. I had already started with Portfolio, working in some of their funds, and I thought, like, I have a network that is strong enough. I don't need to get this and endure it anymore. I'm going to now. It's time not to longer fitting, but really rise. And that's when we started the Portfolio Rising America, focusing on investing in Black and Brown and LGBTQ founders or companies that are somehow addressing those markets. And that's the thing that I wouldn't have been able to do if I had continued on my venture fund, because it was like not something that they liked me doing. And then I realized that, what, I'm going to create my own angel network, and I created the Business Angel Minority Association that actually is getting a lot of inbound from many other networks that were not treating people fairly. So there is a space there, and I think people need to start to step up. And if you don't like things, you need to start doing things on your own and not wait for anybody else to change them for you.
Thank you for that. That's great. Kai?
Yeah, so on my end, I spent 10 years as a founder. After I sold my third company, I thought I was just going to start a fourth business. And I was like, this is all I know how to do. I actually think being an entrepreneur is probably like the worst profession you could possibly have, unless you are just crazy and like want to change the world. And so I'm not somebody who's like, there's a market, there's a TAM, there's a this, I'm going to go and do it. It's not worth it. The amount of work and effort you have to put in could make money a lot of other ways. So every product I ever built is because I actually really believed in it and that people should have it. And I didn't know what that fourth business was going to be. I was at a complete standstill. I had been trying for a year to be creative and, figure out what it was going to be. I got a call from a former investor who had joined Comcast Ventures and said, look, we have a fund. There's some investments in the portfolio. There's still a bunch of capital left to deploy. Why don't you come in and help us? And so, it was great for me because the entire commitment of coming into venture capital was 100% an effort to coach, advise, and mentor early stage African-American and Latinx founders. That was the best part of it. It was, here's 10 years of knowledge and all the things I've done wrong and all the other founders I've seen and mistakes they've made and the things that have gone well, and try to just give some of that like tribal knowledge of being a founder that you can read all the blog posts you want and you can talk about it, but unless you've gone through it, it's really hard. It's like telling somebody to ride a bike. It seems easy, get on, pedal, you brake and you get off, right? But you fall over a bunch of times and you're going to do the same thing as an entrepreneur. So that was really the focus for me. And it was great because not only could I mentor and coach people, I knew I was going to take 400 meetings a year and do 4 or 5 investments. But the capital allocation was meaningful that I was able to cut checks for. And so I learned the craft of investing, there through a larger corporate, and, was very fortunate to be able to, have people around me who had spent a decade looking at deals, right? And the same experience I was transferring over into the Black and Brown founder ecosystem, I was absorbing at the same time on the venture side. And so I co-invested with Courtside on 5 deals. And I was like, this fund doesn't seem to care that these founders are Black. Like, this is great. Like, nobody else. I bring these deals to everybody. I'm like, I got a company that's doing tens of millions of revenue. And, and I'm walking them into offices and the VCs that I know are like, that's probably not a fit for us. And I'm like, okay, and so I ended up joining Courtside because they didn't care, right? Like, my partner Vasu, he's Indian, but he wrote a long blog post about this. He's like, I can't understand anything about African-American life and culture, and what it means to struggle being Black. But I can tell you every time I go to the airport, the problems I have. He's like, I wear a Team USA basketball shirt every time I go to the airport because I get stopped and pulled aside and searched and harassed the whole time. So I see a slice of bias and racism in America that's very different from your experience, but they have obliterated those lenses. And so, it was a really, unique path for me to get into venture. And I started 2 gaming companies and I started a sports media business. And given the focus of the fund and the fact that 40% of our investments were in underrepresented founders, without even trying really, right? With just being open to seeing different types of deal flow and knowing that most of the people, a lot of the people's money we manage, professional athletes, they don't own the teams, but they're making all the money for all the teams, right? And, how do you take this transformation of wealth? And so to bring it full circle, which is why is this so important in the venture ecosystem? If you look at the structural impediments in this country, our parents were lawyer, doctor, Big Four consulting, that was the career, right? You'll be rich forever. You'll be fine. You don't have to worry about money if you get one of these types of jobs in investment banking, et cetera. But if you want to talk about wealth transformation, right? And you look at something like the PayPal mafia, being able to take that money, co-invest, start new businesses, multiplying money, right? And that's why it's actually one of the questions I have for everybody on this panel, which is the Valley is unique because everybody made money from tech, right? So you come to New York and it's private equity, it's advertising, it's all these other businesses. And so people are much less likely to make an angel investment. I'm a real estate guy, I can make 2x here. I'm private equity, I can make 2x here. They're not making a 10x, right? And that mentality in the Valley was what was strong, right? And I think David mentioned something about this, the fact that you see this disintermediation, right, of talent now being distributed, right? And then starting these pockets is like, how do you take both the amount of wealth, right, that's coming in from LPs and institutionals, right, that Mac's getting, you take this, a new kind of a landscape across the country where hubs are popping up in Cincinnati and Detroit, and you have this perfect storm, right, of no one else is paying attention to this, right? And it's like, we're seeing those opportunities, right? And so that's what makes it fun. But fundamentally, it's about transformational wealth creation in this country when there's really no other way to do it. It's high risk. It's not easy. The pressure is incredibly hard on everybody on this panel. You guys look great, you look calm. Like, I know when they go back and they're running their quarterly updates and looking at what their IRR and their MOIC is, it's like they're just as stressed out as the founders that are out there. But I'm really interested in, how do you see this ecosystem development, right, outside of the major tech hubs, where you'll start to see people be more willing, and Juliana, you mentioned this, the small kind of incremental 5, 10K checks of getting the bigger buy-in, right, of the community, because that's where I see, I'm in New York, it's hard, right, to understand why somebody's going to take that risk, right, with a small amount of capital. Venture is very risky, and I'm sure your fund returns are all great, but it's still a risky asset class, right, and it's difficult to play in it, but it's a worthwhile kind of endeavor. So, I said David, go off, and I'll kick it over to you.
Well, it's a great question, Derek. If you don't mind me just answering, because I think it's
Please.
because I think that what we've seen in a lot of these communities, I think the big thing for me that I think is important to remind everybody is while so much of venture, 50% of venture capital in the U.S. basically goes to Silicon Valley, right? But 75% of Fortune 500 startups headquarters are not in San Francisco, right? They're in Detroit, they're in Atlanta, they're in to every time you fly on a Delta airline, you're sending money back to Atlanta. And I think that this notion that the expertise in scaling airlines, or managing through hospitality, like, or building like home depots or other sort of home improvement retail stores, is in like around 285 Beltway or somewhere else. And I think that lived experience, the idea that it's going to be so easily techified, right? Web 2.0 was all about sort of building into the white space. How do I build a Facebook group online? How do I connect all of these users online? How do I enable an e-commerce engine that allows them to work online? Web 3.0 is reinvigorating education, healthcare, retail, all of these staid industries that have trillions of dollars worth of incumbency that's waiting to be cannibalized, that's waiting to be disrupted. And I think that the idea that there's a man and a woman sitting somewhere at Procter and Gamble right now that's got the idea that's going to change that company. That idea, once shot up the totem pole, is going to get killed at level over level. But once it's extracted and it's started up on its own as a separate venture, can topple P&G or 3M in Minnesota or HCA in Nashville or Exxon. And I think we're waiting for that type of innovation. And I think that's the kind of thing where I think that the regional ecosystem, the re-regionalization of tech ecosystems is actually helpful to infuse that tech know-how with that deep industry domain expertise into something that can be really like Web 3.0 disruptive. And I think that's the hope that I'm seeing with a lot of this sort of exodus from the coasts. And if that can really start to like take hold, I think it's gonna be a great flywheel that's gonna start spinning around that.
And just to build on that, right? One of the things that makes Silicon Valley what it is literally a density of capital and talent, right? It's just the density, right? And so what we saw during COVID was that density got dispersed, right? And that's what to David's point. But to Kai's point, like, how do we get these other communities to rise up? It's by us creating the next PayPal mafia. That's not just one place, but it's distributed. And so a great example of that is one of the companies that I funded as the very first investor when I was working for the state of Maryland. When they went to go raise their seed round, guess who they went to? They went to David in DC, right? And that's an easy handoff, right? Right. And so like that's how that happens. So like it's us working together at different levels of the capital stack, where okay, if I know I'm in Baltimore and there's only so many other early stage investors in Baltimore, then let me get to know all the other early stage investors that aren't in Silicon Valley, New York, and Massachusetts, so that when those companies start to do well, I can make those introductions, right? Like there's going to come a day where me and Kai, or a company I invested in, Kai's going to do a follow-on investment in, right? Like that day is going to come, and that's how we build that up, right? And like shout out to Black VC, right? An organization bringing Black venture capitalists together, where we're now sharing deals and being intentional about how we make sure that these founders we're meeting aren't getting left to die on the vine because they got that first 150K, but now that they need to get to 750 or $1 million, nobody knows where to take them. Well, no, I know exactly where to take them. I got a whole Rolodex of people I can take to, right? And so that's really the step that we're getting to, and it's incredible to see because, like, when I started in 2010, Dave was the first Black VC I ever met in person, right? But now, and like, if somebody asked me how many other Black VCs were, I could have pointed to like 5 or 6 of them. But now, if I want to fund a company, and I literally had a company say, "Hey, Mac, we want our round to have a cap table of only Black investors on it." Cool. I got a Rolodex of over 50. I couldn't have done that in 2010. I couldn't have done that in 2015, right? And so
couldn't have done it 2 years ago.
I mean, honestly, right? And so like the ability to do things like that is how we're going to help these companies that aren't in the major tech hubs, because there are VCs like the folks here on this in this panel who care about it and who are going to work together. And that's the great equalizer, the ability to get on Zoom and share a deal or have a pitch or go to a board meeting. You couldn't do that before. Or if you did, everybody thought it was janky. Everybody's been on Zoom for the last year. So the idea of going to a board meeting on Zoom, like if you're not on board with that and you still talking about you can't invest in the founder that you haven't met in person, then you missing the train here, right? Like you're going to get left behind. And so that's how we get to the next step.
I couldn't agree more. I think before we were in pockets and we were not organized. Now with Black VC, with Investors of Color Network, you have all these monthly syndication calls where you start seeing, different funds getting together to make deals happen. David, you talk about Canaries. That's one of our portfolio companies at Portfolio Rising America. And I see that, suddenly a lot of people say, right, that Black and brown founders have, we have a pipeline problem, that's why. And that's not true. It's, these people have a network problem. We no longer have it. We have more than enough amazing deal flow. And the part of the density that you're mentioning, I think is really important to not to try to become a next Silicon Valley. I think we all need to build on our strengths. For Houston right now, we're trying to transition. So climate tech is huge, and we have the strength to make that happen. And I think, each pockets have their different strengths that they need to play on. And I can see a lot of VCs that are now moving out of Silicon Valley because they don't need to be there anymore. So who knows? But definitely, I think we're at the right time at the right place.
It'd be real interesting when Mac starts elbowing me out of deals to up his ownership when he's cutting them bigger checks, yeah. He's like, yeah, I shared deals with Kyle a year ago. You're going to be on this panel 3 years from now being like, yeah, I elbowed him out of a deal last week.
I don't have sharp elbows yet. I don't have sharp elbows yet.
And Kai, in 2 years, it'll just be a keynote with Mac and Derek. The rest of us won't even be invited. And Mac will have on a black turtleneck and some funky red glasses.
Yeah, man. Come on, bro.
Mark my words.
We need to get a name, right? We need a unicorn to call ourselves the Mafia.
Well, look, you guys all have spoken to bias in this sector and how, sort of folks think about investment in what, I think we could arguably say is an emerging market. Can we drill down a little deeper and talk about, sort of what your evaluation criteria, knowing what you know to be true, is when it comes to thinking about a worthwhile investment? How do you evaluate, sort of, the startups and the profile of the startups that you're investing in, breaking away from the Silicon Valley model?
Because, that's always a hard question to add because every deal's different, right? Every deal is its own living, breathing thing. I think the unique thing is when you meet a founder from a different background, sometimes having that cultural competency of understanding what they're building and what they're doing can be a real edge, right? So, there's a founder that, we invested in who I would say is very passionate, right? Some people might say he has a chip on his shoulder. Some people might say he's arrogant. No, it's just a passion because he really cares about what he's doing. And he's always focused on execution more than he is fundraising, right? So that may throw some investors off. But it's not because he's a bad entrepreneur. It's just that he doesn't know the game of venture and doesn't really care about the game of venture. He cares about creating a great company. And, some VCs may get turned off by that. Well, a founder like that can back all day, every day, right? Like you care about execution more than you care about doing these pitch meetings. Yes, come on, founder, right? Being able to understand founders at different levels is probably what sets the folks on this panel apart. But like the evaluation of a deal is the evaluation of a deal, can you execute? Are you in the big market? Does your team have the skill set to build what you're trying to build? Do you have traction? And if you do, how fast are you growing, right? And like the traction piece is where a lot of founders get tripped up and get hung up at, right? And granted, getting started, especially if you come from a community where you don't have friends and family capital, understand it can be, it's tough, right? But there are ways to get through that, right? And there are things you can do to execute to still show that you can get traction. And so, like, I can't set aside that piece, right? What I can do is, like, if I have a founder come to me about, take a company like Rebundle, based out of St. Louis. They make plant-based biodegradable braiding hair, right? You ask me, that's a no-brainer. That's a market that could win. I don't know if every VC sees that, right? And so I think that's the thing that makes it different when it comes to evaluating companies. But at the end of the day, like, I got to return capital to my LP. So, like, the evaluation is the evaluation. I got to return outsized capital. That's I got to get the alpha. That's the goal, right?
So Mac, the only place I would disagree with you slightly. I mean, I like the number one job to me of the CEO. Like, once you've taken money, you are no longer purely an entrepreneur. You're a founder and CEO.
Fair
and
enough.
I think once you're the CEO, your number one job, I think, is to not run out of money, right? And I think that the ability to, and I think that the fundraising acumen, we shouldn't, poo-poo or minimize. Like I'll never forget. I had a founder very early in my career. He was like, I'm having trouble because, like, my investors are calling me all the time. I'm out fundraising. Like, my product team is asking me all these questions, and I'm trying to get them some product advice. I've got 3 customer calls lined up, and I'm just like, I'm not sleeping. I'm having a hard time going through everything. I'm like, congratulations, you're a founder, right? Like, this is the job. And I think for me, one of the big things is the founders that are most successful with me are the ones that recognize that, like, you need to have your elevator pitch and your fundraising pitch and your fundraising, antenna always attenuated towards the money and the close and not waste time with the BS for wasted conversations about, if you're not going to be a yes, I want to move on. Focus on my elevator pitch to this person, because who knows where that next, $250 million investment is going to come. And I like those founders that recognize that and hunt like that. But I also need there to be some sort of right brain, left brain schizophrenia, because I need them to also be able to go deep on product and really understand the voice of the consumer and the product that they're building, if they're, irrespective of it's a D2C or B2B product. Like, I just need them to really be able to inhabit the problem that they're solving, because I see so many elegant solutions looking for a problem that just like, it's like nobody has this problem. You are solving a great problem that nobody has. But those people and this is why I love founders who are their own first customers. They're building their own product, because they're like, when I was working at, Deloitte, or when I was working at Morgan Stanley, I ran compliance, and there was no one click all, do all software that handled all my compliance. So I built it, and I, tried to sell it back to Morgan Stanley. They were my first customer, for example. And I like, those are kind of businesses I love, because they're solving a problem. They keep the swagger, and then they stay a little coachable. They recognize. I've once given a founder feedback. They I've been working on this deck for a week. Here it is. I'm like, deck's not very good. And that founder came back 30 hours later with much improved. I mean, we walked through some feedback, but like, the coachability, how can you make yourself get better, is so important. Those are the 3 things for me: a little bit of fundraising swagger, a little bit of product solution, and like, be coachable, do better.
Let me just clarify for you, though, what I meant by saying, like, not being able to pitch and everything. As a pre-seed investor, I can invest in you because, like, I can help you get that. Like, I can teach you that. I can't teach you how to find the right problem and find the right solution to that problem. Like, I can't help with that. That's what makes you a great entrepreneur. The pitching and the fundraising, like, you can learn that. We can teach you that at the early stage. So by the time they get to you, you don't have to worry about it.
Thank you for your.
I think it's fascinating. It's like, so there are great entrepreneurs and there are great CEOs. And the path from being a great entrepreneur to being a great CEO is the coachability, right? So, to me, that's what I look for over indexing anything, right? So to be a great entrepreneur, that's your founder, your founder fit, right? To me, that's what makes the pre-seed. You're like, yes, I know this person knows this industry better than anyone, right? It is the quintessential founder company fit, right? They know their space, they know their vertical, they have an outsized amount of information, and they're going to make a great product. Being able to be a great CEO of hiring, fundraising, managing PR, balancing out internal strife and issues that are going to happen. Like, nothing goes right in startups. Like, I've been part of some of the fastest growing startups ever. Like, everything, you're like, the servers are breaking, this thing's on fire, we're getting sued. Like, it's just the ability to persevere through that. So I think inevitably the coachability needs to come from the investors down to the CEO down to the team. But that perseverance of being able to continue to run through brick walls and then understand when someone's like, don't run through that brick wall. You could jump over it. You could go around. You could dig a tunnel. Like, there's a lot of ways, because at some point in time, you can't continue to do that. And so it's this cycle. You know, I consider myself to be a good investor who's becoming a good venture capitalist. But when I was at a large firm, all I had to do was invest, right? I didn't have to fundraise. I didn't have to do quarterly updates. I didn't have to do all the back office administration. And so I think it's actually very similar, right? That I always said, you know, for me in my entrepreneurial journey, I was not a good CEO until my 7th year of being an entrepreneur. And it will probably be similar, don't let my LPs hear it, from, you know, to be a great investor, right? It's going to take some time, and it does, right? And luckily I was able to be at a large firm where I learned some things the hard way and didn't have the same type of impact. But that to me is what I look for in a CEO.
So, I mean, and I think, you know, it's also a lot about knowing yourself and what your skills are. And if you're not the good person, I mean, once we get more people on board, of course, you can have someone, the one who's going to be pitching, and you maybe are the executor. But I think knowing yourself, your key skills, who's going to be maybe backing you up in terms of what the needs are. But I think the last thing that I wanted to say about a key skill, because you've mentioned the others already, for me is governance. You know, I think there's a huge correlation between the success of an investment and the governance, and the fact that, you know, the companies that normally succeed have a very well thought approach about how to deal with their investors on a quarterly basis, either through reporting and you know, KPIs, taking that opportunity to also do maybe a newsletter, take that opportunity to see what else their needs are. Normally when they have those updates, they ask for help, and getting all these investors, you know, up to date, even in the things that are the key risks for the companies, to see how they can help and how they can avoid those things, I think is key. And I detect a lot of the entrepreneurs that are good at that, or, you know, when they actually, as soon as they've met you, they put you in a sort of stakeholder newsletter that doesn't have to be the same one as an investor one, but they keep you up to date on the key milestones, the key successes, the key challenges. And once you get to know them, you know, because you receive that information on a quarterly basis, it's very easy for you to pull the trigger when you feel like, you know, they're ready for my investment, or at least for my due diligence. And I think that's something that is pretty key.
Derek, welcome back, man.
Yeah,
Thank you.
Derek, I see
You were on David's Wi-Fi?
Man, my Wi-Fi, don't talk about my Wi-Fi. It's janky, but it's all good. It works when it needs to. Hey, well, Derek, yeah. I think you have a question in the chat about traction that I think, you know, Mac just put a little treatise in there, but I think that I guess I would answer it a little bit more esoterically. What's the level of traction at a pre-seed / seed stage? I think for me, particularly for seed, the way I would answer this is a couple things. The first thing is you've deconstructed and broken down product market fit to be something that that the company is actually identified, right? Like, I know what this market needs, and I am building the product. I have a good start. I have a good viable commercial start to that final ultimate sort of, you know, gold-plated product, number one. Number two, you're really figuring out, to me, like, do I have a viable business model? Will my revenues exceed my expenses? Because there are a lot of businesses that have, again, great business models, but you can sell dollars for 99 cents all day long, and that will not end well for you. But does the business does the fundamental of the business work? The third thing I would say is, like, are you able to, and this is a real traction point, have you been able to sell somebody, not a customer, but an employee on dedicate? Like, I would say that the toughest sales job is not somebody who's going to pay you, $20,000 a month in ARR or MRR, but somebody's going to pay you with 24 hours of service every day. And if you can't sell and close, a couple of like senior level executives, I really worry about that business scaling beyond the seed level, because I just, like, you got to be able to get some help. You cannot do everything in a company, even at a seed stage. It's where you go from 2 to 3 to 4 to 10 people. And if you can't recruit, like, that's a big traction tell. But it really, from there to whoever asked the question, I think Eric Quick asked the first question, it really does vary so much. If you're a B2B company, you're a D2C company, you're a CPG company, where you're selling, who you're selling to, so much is dependent on that. But you got to, I think that they're traits more than there are like traction bright lines.
Man, I could talk about an hour about hiring. You mentioned hiring, and I was like, in my head, I was like, oh man, like we could go for another hour just on that topic. Like, we've seen this time and time again, and I think, it's something that gets buried sometimes, right? The ability to attract talent is what draws other talent in. Amazing engineers want to work with amazing engineers. Amazing designers want to work with amazing, like, it just elevates everyone. I had an 8-person company that we were outpacing 60-person teams with that talent. And it's not just a 10x engineer, right? It's like the ability for them to deliver on something requires everyone to be at that level. And so, I know that wasn't part of the core question, but I do think when I look at an early stage, in addition to the founder, your point of who have you attracted to work with you? What type of engineer? What type of product manager? Where are they coming from, and why are they joining you? And what do they see in you in this vision that they got behind, right? And that is just as hard as a sell. That's correct.
Other team members or co-founder or the early founding team are your initial investors, because they leave whatever they were doing before to join you in this crazy adventure. So the caliber of these people also tells a lot about your ability to attract other kinds of investors.
I have a really interesting question that I want to throw out before we wind down here. How do you determine if an investment is a success or not? And then, how do you pull out when it's not?
Oh man, that's a hard one. I will give you something that we think is valuable. So for every deal that we do, we have a 20-point rating system. Each partner rates the deal. It's a scale of 1 to 4. And we've benchmarked every single deal that we've done. Now, it's not the indication of whether or not we are going to invest, but they are the critical metrics that go into evaluating that, along with the investment memo, of whether we do our pro rata, our super pro rata, or we don't participate in the following round, which is a really hard thing to do at an early stage, because you do not want to pull out your investment dollars, because you're putting that next fundraise in complete jeopardy. That being said, we have an honest conversation with the founders. We go back, we look at this investment memo. Your numbers said this, and you're here, right? You didn't hit these critical metrics. Why not? Where are you? What have you done to address those? Is it a market condition? And sometimes they are. Sometimes they're the founding team's problem. But you have to hold yourself accountable, because inevitably, the reality of our industry is that you are supposed to return outsized capital to our investors, right? So we're backing visionaries, we're backing entrepreneurs that are taking huge risks. And our job is actually to run towards risk and deploy those dollars there. But if you do it and you don't return capital, and unfortunately, it is not a successful investment. This is a very black and white way of judging what types of investments you continue to do and where you allocate capital. And you're not going to have another fund if you don't return the capital that's necessary. So unfortunately, the reality is most funds are raised on paper gains, because you're not going to have a lot of liquidity in the current fund cycles that we're seeing in the 2 to 3 year windows. The inevitable success in our portfolios, oftentimes from fund 1 to fund 2, is what is the markup of the deals that you have, the number of markups and the rate of those markups. By the time you hit fund 3, it's what have you returned on fund 1, and what type of capital have you been able to return to your LPs? And so we're looking at the world through very black and white terms. And oftentimes I think founders who have ambitions and dreams and goals of transforming the world and changing the way things work are not necessarily aligned. So we go through a rigorous exercise early on when we invest to tell people, this is what we're looking for. This is what we've agreed to when we invest, that these are the goals you're going to hit, right? And this is where we're going to track for the next round. And this is what we should be expecting, right? And if we don't, we have a hard conversation. But that's the reality of how we at Courtside, and I think many venture funds, evaluate success of their investments over multiple funds, because inevitably it is looking at it probably over a 9-year cycle. Our average exit is 9 years. We will likely be on fund 3 by the time you start to see some success with your portfolio.
David, Juliana.
Same thing for us. Success, is about returning. That's the kind of success we need to have to be able to raise. And so far, it's only fund 1 for Rising America. But I think, I would add some kind of impact, and that's something that when we actually put together the thesis for Rising America, we just focus on the fact that the founders will be Black and brown or LGBTQ or, some company that could address those markets. But then when we started investing in those companies, we gravitated towards the ones that have some kind of impact component attached to it, so that, on top of being great companies, they do something else. And of course, fintech and financial literacy are really big. So that's where we got engaged in Mocify or in Suma. Same thing for companies that have this DEI component like Canaris, or this health component with social determinants of health. So we kind of have gravitated towards those just because, we wanted that of impact to bridge all the gaps we needed to bridge with this fund.
Yeah, I think for me, I'll start with the hard decision, the hard conversation of saying no. And I think a lot of it is all about, I've given you enough gas money to get from New York to LA, and you call me from Chicago. And you're like, that was not part of the stop. You weren't supposed to be stopping in Chicago. Why are you in Chicago? You're like, I just need a little bit more money. And then I call you again, and you're like, yeah, I'm in the Grand Canyon. And it's like, what the hell? And so it's like, it's this constant, we set expectations, and it's not that the expectations are missed. The expectation, you're in a totally different time zone than you're supposed to be. And I feel like that's where, it's a communication issue. Is it the market? Is it the entrepreneur? And so I feel like those conversations are had. And I think Juliana talked about this communication and the updates. These conversations are set months or quarters before they actually happen. And I think that it's, we're all joking with ourselves because you see it and you're like, I know this is not going to go well. I know this is going to end well, because I'm saying let's be, and I think the big key here is always being data led versus gut led, because your gut will lead you off the Grand Canyon. The data will lead you to start to recognize, I need to recalibrate. I need to cut off the AC or whatever, to extend this bad metaphor, to keep enough runway to get to where I need to get to. But otherwise, that's our job. Our job is to say we're not using the same KPIs to move forward together. And if that's the case, hard to move forward together, because that trust has kind of been broken. But I still think, I think that we're moving in a great direction really, really quickly. And sometimes you got to be flexible. And I want to end on a positive to say that sometimes it's like these businesses that call you up with the surprise. And those are the best calls as a VC to get, where it's like, I just bagged Apple as a client, and we, at 3x the ARPU that I thought that they were coming in at, because they saw the vision in a way that nobody else saw. That's the call that you want, because that is showing that it's working. And then that's the thing that gets VCs to open up their wallet to be like, take all my money. So yeah, I would end on something positive.
The last question that I'll throw out, and I know we have to sort of jump off shortly, is what do you want to share with other folks who are thinking about going to start a fund out there? What have you learned in this process that maybe you didn't, that it took you 3 or 4 years to learn, that you want to sort of convey to people who are on this journey and new? What advice would you throw out to them? What do these folks need to know to become successful investors is really what the ask is.
the most in-depth thing we got to go off of. But I'll look. If you want to raise a fund, know this: raising a fund is hard, right? Entrepreneurs, when they're raising capital, call it 3 months, maybe 6 if they're struggling. Raise a venture fund, you're talking about 18, 24 months. You're just out there on the grind, raising. So be prepared for that. Get yourself a team. Even if you're going to be a solo GP like myself, I still got a 7-person team because it's just no way, right? Make sure you got yourself some help and think very, very critically about differentiation, right? Just like entrepreneurs who come to VCs and like, I got the next greatest fintech company. You're like, I just saw 3 of those last week. Same thing for LPs. When funds go to pitch them, they're looking for differentiation. And take your time and really think through what that is and why. Because there are a lot of funds out there raising. Most funds don't raise. And part of the reason is because they're just not differentiated enough. And I'll try to keep it short to that.
And follow up on that and the fact that the differentiation and the thesis is key. And sometimes the thesis is hard, because once you commit to a thesis, you have to stick to it. And we are at this turning point where deals are becoming very interesting and you get these opportunities and suddenly you want to be like, hey, you know what? I have FOMO here and this deal looks so yummy and everybody's in and it doesn't fit my thesis. So can I make it fit somehow? But I think it's important for you to really try to stick to what you're doing, because a lot of these kind of opportunistic look good deals are going to come in. But if you don't have a way to structure your thesis and follow it and make sure that that's part of your competitive advantage, somehow you're going to lose focus, and LPs are going to see that. So it's also not only about differentiating yourself, but sticking to that and not going all over the place and do the spray and pray thing. You need to be more focused.
I would say that.
Go ahead, Kai.
Sorry, go ahead, David.
Go ahead, please.
Thank you. I would just say that in terms of thesis-driven, in the areas that we tend to be investing in as emerging managers, I underappreciated the amount of education it takes. So when you are a thesis-driven fund and we're investing in sports or we're investing in gaming, and healthcare funds, they're looking at generalist funds, they're looking at, crypto funds, they're looking at 12, 15 different verticals. They may not know the space you're operating in. So we go in with a certain assumption that everybody knows gaming's a $160 billion industry and that there's enterprise software and, core. They think of gaming, they think of, you're investing in a gaming studio. And I'm like, no, there's game engines that are, Unity as a platform, as a multi-billion-dollar company that's gone public, and that has nothing to do with the risk of IP. So, I think it's probably true of climate change. It's probably true of investing in the Midwest. It's true of investing outside of these other major pockets. You are educating these individuals oftentimes because that relationship is going to take you 10 years. Like, you might be lucky and you might be like Mac and get a couple of institutional investors early on, right? They want to see you grow and move with them. But oftentimes you're like, this is my fund 1, come back in fund 2. Oh, this is my fund 2. Great. That's good. You finally have some liquidity. Great. Let's talk about fund 3. And these are 12, 15, 20-year relationships, and people discount how long this capital is. You're looking at these foundations, endowments that are thinking about managing money for hundreds of years. And you're thinking about investing in a fund cycle, right? And so they're like, well, why this entry point now and here? Like, I've got an infinite amount of capital I can deploy. Why am I going to go with you at this moment in time? I can wait, right? And so that's something that people forget, right? That capital cycles are long. Educating people on why your vertical and your thesis is the winner can take more than a couple of months. It can take multiple years before they commit.
The only thing I'll add really quickly is that, everybody's default is no. And getting to yes is part of the job, right? Like, that's our job as venture capitalists. 99% of the time we say no. And, our same pitch, 99% of the responses are going to be no. And I think that it's all about finding the yes and then asking that yes, or even a lot of the no's, who do they know that's more likely to say yes? because your goal of all of this is to get to yes. Yes for the deals, yes for the talent, yes for the other investors, and yes for the capital, the LP capital that helps get you over your threshold number. So I just think, get comfortable with no, because you're going to hear it a lot, and and plot your way through chess, not checkers, to yes.
Look, I appreciate each of you being here today. This is a conversation that doesn't end at Urban Tech Connect by any stretch. I love the idea. I get chills thinking about, create the next PayPal mafia, around
The
innovation.
Urban Tech Connect Mafia,
That's right. And just would love to continue to stay in touch with each of you. Keep us updated on what your happenings are. I see some of you posted a couple of things in the chat. David, you guys have a career fair, happening across the country. We'll plug folks into that. All the best and good luck with everything that you guys are working on, and look forward to staying in touch. Thank you.
Thanks, everybody.
Bye.
Thanks, Derek.